Hello everyone, my name is Ed Prothero, Strategy Consultant with the Association of Real Estate Funds. Welcome and thank you for joining us today. We have a double first for you today actually. This is AREF's first ever webinar and it is also the first event we have dedicated to the residential sector. Our thanks to Patricia for sponsoring today's webinar. The AREF board has launched a strategic initiative focusing on residential, an area previously underrepresented within the association and probably underrepresented generally speaking. Our aim is to make AREF the central hub for institutional funds investing in the residential sector, whether solely or as part of a wider portfolio. By bringing the key stakeholders in the industry together, we can further raise the profile of residential investment, promote best practice amongst funds, and give this sector a voice to hopefully help it evolve. We are currently setting up a residential investment working group, and today's webinar is just the first of a number of events focusing on this important sector. So if anyone listening would like to hear more about what we are up to on this front, please do get in touch. My email is on the screen now. So some housekeeping points before we start. During the discussion, all participants will remain on listen-only mode. We will be recording today's webinar as well, so it will be available for later broadcast. As with all our events too, this webinar will be run under the Chatham House rule. Please submit your any written questions that you have anytime during the discussion using the Q&A panel on the right of your screens. And we will try to include as much of those questions during the discussion as we go along. Again, your feedback is very valued by us, so please do fill out. Take a moment to fill out the pop-up that will come out at the end of the discussion, at the end of the webinar. Now I'd like to hand over to today's chair, Ian Mason, Portfolio Manager at AEW Europe and board member of AREF. To introduce today's panel, Ian.
Thank you, Ed. Good afternoon, everybody. I think to start with, I just want to say that we don't really want to get bogged down in what defines a mainstream sector, but I thought some stats which I've found from an IPF study way back in 2018 are actually quite enlightening, which said that the size of the UK resi stock is estimated back then at about £4.6 trillion. That then was 7 times the size of the commercial stock. Now, most of that, as we would probably expect, of that 4.6 trillion is owner occupied, but they identified that almost 850 billion was in private rented sector, but mainly owned by private individuals. What they described as conventional commercial property investors, who only actually owned about 2% of that 850 billion, which meant that residential was only about 1%, and still probably is, of the MSCI UK universe. So, you know, that in itself poses some interesting dynamics on the sector. I guess that whenever I've looked at a new sector, it's always been the investment fundamentals that drives the process, and if the investment case is strong, that's when I'll look at the impact from the market's perception of whether a sector is mainstream, niche, alternative, or other. So that's really how I want to approach this webinar, particularly for the investors who are listening in. Really for us to look at the fundamentals of supply and demand in the UK, the risks and the returns, the investors who are attracted to the UK, and really how the UK fundamentals compare with other maybe more established international markets. So just to introduce the panel, we have got, in no particular order, Ed Crockett, who is head of UK residential investment at Aberdeen Standard Investments. We have Sebastian Dietert from Patrizia, who is director of residential fund management. Douglas Crawshaw, senior investment consultant at Willis Towers Watson. Jette Tropper, who is an executive director from Prudential Real Estate Investors, and I think most interestingly, for the purpose of this webinar, really great to be joined by Jennifer Murray from Homes England, which is really where we want to start with you, Jennifer. I know you can't get deep into politics, but a new government, does that change the way that Homes England are looking at what could be described as a housing crisis?
Ian, in a word, no, but I expect that'd be quite a short answer. I'm very conscious that many people on this call will recognise some of the other company names around the table, but maybe not so much Homes England. I myself am a relatively recent joiner, so I want to say a little bit about Homes England's mission and objectives, and then touch on some of the supply side points that you touched on. So Homes England launched 2 years ago as the government's housing delivery agency for England. We're here to work with partners across the public and private sector to accelerate delivery of the 300,000 homes per annum by the mid-2020s that remains the government target. And we use lots of words like accelerator, but we aim to be a catalyst. And our mission is to step in where the market will not, or is not yet ready to. And we're able to use a range of tools from our expertise, our land holdings, and from my perspective, importantly, our finance capability to unlock investment and land to deliver homes in the areas of most need, where affordability pressures are greatest, and create a resilient and diverse housing market. And that diverse piece is important to us in terms of the kind of stock that's supplied, but also in terms of the kinds of participants we have, be that developers or be that long-term investors. From a finance perspective, we have over £11 billion worth of capability from HM Treasury to support our private sector partners with infrastructure loans, development finance, and increasingly equity participation that encourages other capital into housing sectors. And this is on top of our grant funding for affordable homes and our debt guarantees. So we would really love to see the UK and international investment management sector being more active in addressing the housing need. And leveraging its funds and expertise alongside us to deliver new high quality homes. And I think if I've got one message for today to the audience, it's very much we're here to help you to do that. In terms of your original question, Ian, have things changed for us at Homes England? I think the election of another Conservative government means it's very much business as usual, but subject to some new priorities for us. But looking forward to 2020s, we have a new government that maintains its commitment to housing delivery and increasing housing supply by at least 1 million homes over the next 5 years. It's very early days for this government, and it has some competing priorities. But the housing crisis hasn't gone away. If we look at the National Audit Office views on household formation, between 2011 and 2021, 227,000 new households were formed, and by contrast, only 160,000 new homes were created. So that's really where this housing crisis has come from, is that we've been creating households faster than we've been building homes, in short. There is an acknowledgement that new supply has to be delivered across all tenures. And to touch on Ian's point earlier about who actually owns rented homes for rent, there is a desire for market rented accommodation to be increasingly owned by responsible long-term landlords who are committed to offering certainty, good quality homes and professional management to their customers and their occupiers. And that's something that I feel very passionately about. And then just practically, even if we take today's tenure mix in the UK, where actually only 60% of homes are owner occupied, in order to deliver 300,000 homes per annum requires 13 billion of new homes in the private rented sector every year. And this is what I have to keep saying to my colleagues and my colleagues at the Ministry for Housing, Communities and Local Government, is that, you know, I think Ed and some of the others can probably correct me a bit more here, but you know, my understanding is that the total of new build to rent stock, everything's been created in the last 5 years, is around 12 to 15 billion. that is only 1 year's supply. So this is something that we as an agency need to take very seriously, and that's why I'm so keen to engage with the investment management world. So the homes have to be the right sort, they have to be in the right places. We're keen to work with partners who are delivering single family homes, multi-family apartments, retirement living, and other emerging themes across both affordable and market sectors. I just finish on this to say that this government is likely to have a commitment to increase home ownership opportunities, but this brings a significant opportunity for investors seeking index-linked long income strategies. And I hope we may come on to that later, because within the shared ownership space is a huge opportunity for investment by institutional partners there.
I mean, I think that stat about the percentage of rent out of that 300,000 is really quite a major number. I mean, Ed, how are you seeing the demand side? I mean, around generation rent. Do you see that as a long-term trend, or is it just?
So I suppose there's two sides of the demand side. So it's not just generation rent. There are 4.8 million households that form the private rented sector across the UK at the moment. And what we're seeing is that year on year, that's growing at the moment. It's settled down for the last couple of years, but we're really seeing that people are staying longer and actually choosing to stay within the sector when even they have the choice to move into owner occupation. That demand pool is much wider than people may first imagine and deeper than first imagined. So you actually look across the demand piece, way more than 50%, I think it's about 63%, according to the English Home Survey, is actually in bungalows and houses, not in city centre apartments. So if you're looking at city centre demand, it can potentially be thinner than you might first imagine. But yeah, the demand it's not just generation rent, it's multi-generational, and as people are growing up with rent, it's clear that they're staying in the rental system. And the Resolution Foundation's got some very interesting stats on what the market will look like in 20 years, where people would have rented potentially for the entirety of their lives.
So on the supply side, then, Jennifer, having identified the need for more than just city centre apartments, do you see the UK response on the supply side as being more than just, I suppose, if I was to observe, all you ever hear about is just the delivery of multi.
Yeah, so it's true. The institutional, where the institutional model has had some success and traction is in city centres, well, in southeast dormitory towns and in regional capitals around Manchester, Leeds in particular, and Bristol coming forward. That's because the model of delivering that is much more akin to purpose-built student accommodation. That's obviously a mature market that's being replicated, and it's much easier to be able to put your arms around the asset and believe in it as a single asset. And institutional investors are getting a lot of confidence from being able to look at that in its delivery model. The reality is there is a far deeper and untapped pool in the more housing-led sector. You've got the PRS REIT that's delivering that by Sigma Capital, and I can see that that's a model that institutional investors may well come to grow accustomed to, and actually that will that is where you might find much deeper demand than is currently present.
Yeah.
The other part that we're seeing is that people are focusing very much at the top end of the market in terms of affordability, whereas actually the depth of demand is in that squeezed middle, as various politicians have probably referred to it. And it's correct, it's what we're seeing bear out. So a more affordable product will allow you to tap that untapped demand.
Yeah. I mean, I think that probably makes a lot of sense from the investor's point of view, but possibly therefore the supply side not necessarily addressing exactly the need as you would see it.
Some risks in that aren't fully borne out when you look at the entirety of the sector and average it all out. You don't necessarily see some of the peaks and troughs of supply demand imbalance. If you look over the whole, that imbalance is substantial and won't be rectified. But if you invest in a city that's had substantial rental growth in the last 3 years as a result of undersupply and is then looking at an oversupply, that investment model could be unravelled pretty quickly.
Yeah. So if we sort of pause there and sort of say that, you know, we've got a very exciting but relatively new sector emerging, which is finding its feet. Good time to bring in our overseas experts, you know, to start to draw comparisons about how international markets have evolved and what lessons that can learn. I mean, Jette, do you want to start off with? I think people do regard the US as being a very mature rental market. Can you see similarities between the evolution of what's happening in the UK with what happened 20-30 years ago in the States?
Yes, thank you, Ian. As you know, I have the benefit of having residential being mainstream already in the United States, but it wasn't always that case. If you look back in the 80s and 90s, it was not considered core. So it's really been in just the past 25 or so years where it is a truly core investment. And some of the core funds in the Odyssey are now up to about a 26% allocation to residential. When you look at our housing stock, we have about 21 million units. Only 60% of that is owner occupied. So similar to the stats that Jennifer had shared, about 1/3 of the U.S. households do live in rental housing. And majority of that is privately owned. So it's really only been recently that the REITs have brought some transparency and have gained some greater acceptance for residential becoming mainstream. And just as Ed had shared on the supply side, we have about 300,000 units being developed consistently over the past few years. Our demand has kept up also for household formation. We have a lower ownership rate today, and we have a lot of renters by choice, but a lot of that new development is concentrated in our urban core. So where we fall short is also on the affordability. And when you look at, you know, our workforce housing is probably our best performing segment of our residential portfolios today. So definitely a lot of similarities to both Jennifer and to Ed.
But do you see the mature supply side then responding to that sort of squeezed middle demand, or are they still preferring to do it at the high end, which is where we seem to be focusing at the moment?
Yeah, I think both. There are still going to be developments in the high-end urban core, but there are developers looking out to the suburban areas and creating some mixed-use projects that are creating that lifestyle and the desirability to be living out in the suburbs, where it tends to be a little more affordable.
Yeah. Okay. Well, I know you cover more than just the States, but I just want to bring in Sebastian really to give us a little overview of Europe and the core residential markets as you see them compared to the UK at the moment.
Yeah, thank you. So as you all know, that we are managing currently around 10 billion assets under management in residential stock across Europe. I mean, from the German point of view, there is a big tenant nature. So we have about 50% of the people in Germany are living as a tenant. So we are used to multifamily in a traditional scheme. We see this also in Denmark, in the Netherlands, where we have strong domestic investor base, which are dealing with residential since 35 years, as we do as Patrizia. And that's why I think you don't have to hide in the UK, because it is actually a mainstream sector, and it should be part of every investor portfolio, that you have a residential stable income stream and cash flow. And this is maybe the most interesting thing in the status of the cycle at the moment.
Yeah, interesting. Thank you. Douglas, if we come to you, I mean, your role is basically to find your investors opportunities across global real estate markets that meet their needs. So how are you viewing residential at the moment, I suppose focused on the UK, in terms of the risks and the opportunities?
Well, thank you, Ed. There are probably a few ways I can start my thoughts. One is that you're right, in as much as my role is to find the best risk-adjusted returns across real assets across the globe that resolve clients' issues, and therefore I am open to looking at any sector in any part of the world. And residential in the UK has been something we've looked at for many years, 7 or 8 years, I think, and indeed many of you on the call will have had those discussions with us. But I think over that time, a number of issues have really come to the fore. One, of course, is where the capital is coming from and what it is looking to achieve. And that is allied to essentially the decline of the defined benefit pension scheme and the inability of the defined contribution pension scheme in the main to be able to take up the slack because of the way DC schemes are structured and administered. Now, that means that we have a reducing pool of capital that is, broadly speaking, looking to match its liabilities as it moves towards buyout and buy-in in the future, the next 20 or so years. So the illiquidity associated with real estate in the UK, allied to the nature of the investment itself, makes quite a big difference to the investment decisions. And what most of those DB investors are looking for is long-term inflation-linked income, and not the traditional type of investment that was the case 5 or more years ago. And that's really quite a fundamental shift. So from our perspective, we're looking for things that can match liabilities as neatly as possible when the UK gilt is at the level that it is at. Now, that means that we can look at residential as much as anything else, but residential has other issues with it before I come on to its benefits. One of which is how it is providing that income stream. Typically, they are short leases, 6-monthly AST leases in the UK, which doesn't really provide us with that certainty of income that we are looking for. Typically, it is difficult to find adequate supply of land and the speed at which the buildings are built to provide us with the income that we're looking for. The bulk of our investor base are not necessarily looking for the capital return associated with profits of building. They want the income from having these assets let up. And that also leads us into the planning system and the fact that you could buy into one thing and in a not too distant future end up by holding something completely different because of the way the planning system works. And what would be helpful from our perspective, for example, is to have a dedicated use class for PRS and its allied sort of subsectors, which should enable us to have certainty over what we are buying into the future. So those are some of the downsides. Having said that, from a diversification perspective, from a perspective of adding something to a portfolio and improving the risk-adjusted returns, residential makes and has always made very good sense. And those of you that invest overseas, whether it be in Germany, the Netherlands, the US, and so on, are already benefiting from having residential as part of their investment portfolios. And it makes perfect sense to do the same here in the UK. It's just that that is overshadowed by some of the issues that we're facing. Now, we have been spending, as I say, 7 or 8 years looking at residential as a distinct investment sector, and we were making very good progress. And that was aside from the buying out of NAMA and those kind of distressed investments of the past. We're making very good progress. But one of the things that has come very much to the fore for our investors' minds is reputational risk, and I cannot underestimate the importance of reputational risk. Now, we are talking about having professional management, which is absolutely fundamental to reducing that reputational risk. But we had a client that was very close, imminently close to signing a very big mandate in PRS the morning of Grenfell. And their pen never came close to the piece of paper that they would need to sign, because that reputational risk was very, very evident on that very day. And very shortly thereafter, we had a ground rent scandal up in the northwest, which, whilst not associated with PRS or other routes or traditional residential, was nevertheless pointed towards the person on the street. And our investors are typically very, very nervous of those kind of what I would call the Daily Mail effect. And we need to find a way of overcoming that in order to improve and increase the amount of capital directed towards this sector.
So Ed, have your UK investors, if they're looking for those inflation-linked income streams, have they satisfied themselves that this assumption that it's a whole series of 12-month ASTs, does that provide the certainty of the inflation link they're looking for?
With the two sides of that question, are all investors who are looking at the private rental sector or build to rent at the moment purely looking for inflation-linked cash flows? No. And the second part, are those investors that are investing comfortable with the AST system as it stands at the moment? Yes, on the schemes that we're doing and in terms of the demand profile that they have relative to supply, we're comfortable that those schemes will deliver a durable cash flow over the next 10 years. So yeah, we've been able to get comfortable on those specific locations. Just responding to one point that Phil was just making, I think it is front and centre. The building quality is absolutely paramount when it comes to our investment underwriting, and it's partly why we're getting much more traction, and the market as a whole is going through development investment funding rather than acquiring stock that's already in the market, because there's no way that we can really establish the quality of those investments. And if you look in more detail at the advisory, one of the advisory notes, advisory note 14, that came out of the initial or the current inquiry into Grenfell, it's making it very hard to deliver tall buildings. So the way that we are as an industry fronting up to that is actually really important. It shows that we as institutional purchasers and managers have a real solution to the problem about future delivery, which is yet to be really understood by the house building industry, I think. So I think it could be the making of the sector, actually, Grenfell, to an extent, because we are doing it much better than anybody else, and our standards and requirements as institutional funders are way higher than the specification of what would be delivered typically by a house builder. And that has actually been one of the challenges to invest, because house builders are struggling to come to terms with what we're asking them to deliver relative to what they could get away with if they were selling in the open market. And that has got slightly easier now. Everyone is starting to realise, hang on, that's what's going to have to be delivered, come what may.
Yeah. So the first question that we've come in from Joanna Turner, thank you, Joanna, is actually asking a question about this planning regime for housing and whether there are plans in place to escalate the development of new affordable, small a, could be capital A, housing stock, and really, suggesting that the planning system is a big hindrance to increasing housing supply. Again, we can comment on that in the UK, but Jette, Sebastian, what you've just heard from Douglas, from Ed, are these some of the growing pains around the planning system and political risk that you've dealt with, and how have your investors got themselves happy with those risks in your markets?
So it's ladies first, Jette.
Okay, thank you. Yeah, I think that's one of the headwinds that we face right now, is certain jurisdictions are trying to implement rent control laws that they think are going to help with our affordability issue. And in fact, it's hindering development and hindering refurbishment of apartments, because the developers and the investors are looking at their returns and saying it's not worthwhile any longer. So some jurisdictions have done probably a better job than others at saying we're going to look at our policies and how quickly it takes to get the permitting and what type of either TIFs or other incentives we can provide, like our opportunity zones, to encourage development that at a cost basis that makes sense, or where they have implemented rent control, they have done it in a way where the caps or the maximum rent increases still make sense from an investor perspective, but it is a challenge. And I think that's why, as I mentioned before, our workforce housing portfolio is probably our best performing segment, because their investors have taken some of the older stock that may have typically been a C property or D property, improved it just up to a B minus or a B, and are still able to charge rents that are affordable to the median income of the area, and make an investment return that's reasonable.
Yes, Patricia, so we see the affordability also in the existing stock in Germany and Denmark and Netherlands, also in France. But if we are looking at new developments, especially in Germany and in Denmark, you have construction costs which are so super high that you have to supply a higher rent. So you are not in the mid segment and the low segment, you are in the higher mid segment or even close to the luxury segment. So, and this is more or less the game that the owners or the developers in Germany, they have to create these kind of quality stock because of energy sufficiency registration and regulatories in Germany. That's why you have to ask for 15, 16 euros, what is for a German perspective really in the high mid segment. If you're thinking about that, the average German is as the gross income is 42,000 euros a year, and then you're 4 people in the family, and then one is there with 2.5 net, and then he has to pay 1,600 for rents. So, but this is more or less the challenge we have to face in Germany and Denmark and the Netherlands as well. But to be clear, so the Netherlands, they are much cheaper in the construction cost, but because they have not such high regulatories like we have in Germany or in Denmark.
Yeah. So in the UK, the planning system is always cited by both sides of any equation as being the problem. So, you know, it seems to me that we've got to move over that hurdle before we can actually start to make progress. I mean, my views on that, looking at it over the years, is yes, if you want something dedicated to PRS or to affordable or to social, then you have to use the planning system to help that delivery. But I'd also observe that the property market, with commercial interests at heart, has always said no, it should be left to the free market to deliver, which just allows them to drive the profitability of these things to the most profitable bit. So, you know, Ed, Jennifer, thoughts on how we finally get the planning system to work for us?
I think the planning question, I'm afraid I'm going to leave a little bit to Ed, because I do think it's easier for people who are engaging with it to articulate what the problems are. And we, the Ministry for Housing and Local Communities is our sponsor department. We feed back as much as we can where the hurdles are, but we need as many sort of bits of evidence as we can to say this is a problem. I did want to touch briefly on the sort of affordable side of that question, because I suspect it may have had both a small a and a capital A. And you know, we don't know yet what the government's sort of new plan is going to be for increasing affordable housing delivery, but I think we're certain that there will be one. So maybe we can do a follow-up seminar or webinar when that comes through. But what we're very conscious of is that outside the local association, so local authorities, very much that capital A affordable stock is held by housing associations. Housing associations have to date funded themselves raising debt on capital markets, which has led to quite over-leveraged positions. And we're very keen to diversify the sources of capital available to those groups providing affordable housing and match the right sort of private capital with this opportunity to diversify the sector further. And I'd touch again on the reputational risk point that Douglas makes, is that what I find quite interesting is when I talk to our affordable housing team and the housing association side, they have a nervousness about the motivations of private capital. And I had spent quite a long time saying that there's private capital and there's private capital. At one end of the spectrum, there is, you know, sort of Douglas was alluding to, there's a middle ground which is still long term and is not looking for very high returns. But you know, we need some people to develop and they need to be rewarded for that appropriately too. So it's just matching, for me, getting that delivery across the various parts of the market are all about matching the right capital with the right opportunities. I'm sure that's possible.
Okay.
So a point about the quality is that we have a development-led investment model in order to ensure that quality. So that has to pass through the eye of the needle that is the planning system. So it is a major constraint on the speed of delivery of units at the moment, is the planning system. Aligned to that, there is a huge lack of understanding of what build to rent can deliver for and what the investors are looking to achieve. And there's a huge lack of trust about the development community. That's partly informed by local authorities feeling that they had the wool pulled over their eyes 6-7 years ago with affordable housing contributions and off-site contributions in affordable housing. That has now meant a pretty aggressive and penal system that sees build to rent as just a way around getting out of that, and it really isn't. It's an entirely different delivery model. Trying to explain to local authorities that we are here for the long term and the well-being of the community is exactly aligned to our investment model. In fact, it is the one fundamental of our investment model. Has been a hard argument to make, and just sitting against what a lot of people have said is that so you look at regulation and affordability across Europe. The most regulated market is Sweden, and yet that has delivered the highest returns in the last, I think, 5 and 10 years. And so that's where we're trying to explain to local authorities, actually, we're not trying to rip people off. We're quite comfortable in an environment that is about benign growth. And again, that plays to the depth of the demand, and getting comfortable with an AST model is actually, if you have much more benign growth, the replicability of income is much more easy to evidence, and so much simpler to explain to an investor about how it actually does look like index-linked income without being indexed.
And we've a question come in about the importance of JV relationships with local authorities. Kind of reminds me of when I was trying to deliver multi-tenure for rent in Croydon, and no matter how much you tried to do that, it was actually the permitted development system that was completely dominating, over which the local authority had no control, because so the owners of those blocks could deliver any shape or size of rabbit hutches, basically. So the local authority were disenfranchised. In partnerships with local authorities, is that a way round the planning system or the delivery? Should it be encouraged more?
It can be as hard. It depends on which local authority you're working with. It can be harder in some cases.
Okay.
And from our perspective, one of the benefits of that is that perhaps I can get my long-term inflation-linked income, which will provide a huge resource of capital. On the other is the potential mismatch between the liability that I would look to the local authority to write a long lease to me, and the short-term income and revenue that they're getting through the front door from their tenants, and the affordability and therefore the credit risk pressures that might come to bear with those local authorities. Something that the regulator social housing is toying with at the moment in social housing, and it's something that really needs to be addressed, because that, if we could do that, it could make a very, very big difference to the likes of us and our capital availability,
which would give the local authority the ability to, through the lease structure, to dictate the quality of accommodation.
Absolutely.
And we're starting to see that in Ireland and other parts of Europe, which is quite interesting.
Okay.
But I think Ed's right, it's very local authority dependent. And if I can make a blatant sales pitch from my perspective, we would love to see more JVs with local authorities, but we know you need to find the right ones. And if we can help be part of that, we're very keen to do that.
Okay, right. We are running out of time, and we knew that this for 45 minutes was not going to be enough time to cover everything, but I have told everybody sat around this table here that we're not going to get away without talking about returns. So, from a UK perspective and from overseas capital, Jette and Sebastian looking into the UK, the skeptic in me, which is how I've survived for 35 years, and probably in you, Douglas, as well, says, okay, what sort of returns, though, in hard numbers, can I actually expect from UK residential, and is that attractive to the global investors?
Who do you want to answer that?
I throw that to you're looking at me.
So from our perspective, it varies very much on which market you're focusing on and which asset and which tranche of the demand you're focusing on. So we're aiming more at the middle to upper middle, and we're in markets that have maybe a little less growth than others. So our income requirement is slightly higher. We're looking at, well, okay, if you're in London, the southeast, it'll be 3 3/4. If it's more regional, it could be up to 4.5, and we're predicting 2% rental growth, give or take.
Right.
Some years will be higher than others, and others will be lower. But if you're investing over the long term, 10 years, it'll even itself out. So you'll be somewhere between 5 and 7, depending on exactly what product you're investing in.
Yeah. Okay. Jette, do those sort of returns sound attractive to a core US investor looking to make money out of UK resi real estate?
Yes, no, I think very consistent with that. When you look at it, it does depend on the product and the market. I think average, we're looking at about 2.5% rent growth with annual returns somewhere around to 6%. I think when you look at the 10-year IRR for a purely core project that has already been delivered, it's probably at 8%. But when you look at value add or development, you're looking at double digits, mid-teens preferably. So it does run the gamut, but it's very consistent with what you're saying.
Yeah. So is that because it's part of a multi-sector portfolio, and whilst residential is 20% of those portfolios, it's having to compete with shops, offices, and industrial?
Yes, and even within the multifamily sector, the demand for value-add properties has greatly increased. So the pricing has gone up, and we have similar challenges with our construction costs. Even on the development side, the construction projects are just costing more now, significantly more to build today. So it's compressing the returns a bit. But multifamily and industrial have still been leading the charge in terms of returns in the U.S.
Yeah. And Sebastian, and then Patricia, making money for investors across continental Europe. Are you bringing that money in to invest in the UK?
Yeah, shortly. We're monitoring the market since years. I mean, our investor base is a little bit patient about the political environment, but I would totally agree to add that you can, from the income side, 3.5 could be doable when we're talking about pure traditional multifamily. We're talking about student accommodation, but you will agree on that it will be higher. Yeah. So it's around 4. So I'm just talking about income. I mean, you have the opportunity to go into the cities if you really find and identify the emerging districts. Even in London, you have the opportunities to get attractive yields, but then you have to go really deep granular in the data, and you have to walk the streets. I mean,
so what returns could you offer me if I invested
in Germany?
In German investment?
In Germany, so if you're going to Munich, then it's in the lower segment of 3. But
of 3,
right? Yeah,
the lowest segment of 3 being
it's 3.301 or something.
Are the investors listening picking up some hesitation from the fund managers about what they're offering?
If you're really going into liquid cities, and I mean, as Germany, we are little Europe, so we have a polycentric structure, and you can even find yields up to 4 income returning in Bremen, Leipzig, and some of the eastern part, but you have to really careful about the liquidity to get the exit structure done in this kind of perspectives.
Yeah. Okay. Well, I mean, we've got 2 minutes to go, so I think if there was one bit of feedback that I think AREF could really benefit from, would be from the investors, just feeding back on what they've heard here about the return profile. Definitely get what Douglas is saying about income, inflation-linked income. Huge, great demand for that from a lot of UK institutional investors, as we can call them, but a lot of other investors out there who might possibly looking for higher returns. So I think that's where we do need to wrap up. Do let us know your feedback on this webinar. If you think there are issues that we need to cover, either in webinar 2 or issues that AREF should be addressing in their initiative into residential, do please let us know. But for now, this is Ian Mason and our panel of experts signing off for Radio AREF.